Thanks for joining us on Parliament. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines this Monday afternoon. Indian equities begin the truncated week on a strong note. Banking and IT stocks lead.
IndiGo stock swings between gains and losses after Aditya Ghosh's surprise decision to resign as CEO.
Reliance is among the top Nifty losers after reporting weaker than expected fourth quarter numbers.
From earnings, expect a strong show by index heavyweight HDFC. Kotak Mahindra Bank is also expected to maintain its growth momentum.
Conversations coming up on the show today. We talk about the management rejig at IndiGo and how it could impact the airline's prospects with aviation consultant Mark Martin. And Fitch has reaffirmed India's rating at BBB-. We talk to Thomas Rookmarker of Fitch Ratings.
The markets first, the truncated week, remember, but it's strong showing led by bank stocks, IT stocks. Neeraj is here with a closer look at what's going on. Neeraj.
Hey guys, good start to the trading day and a continuation of what happened in the first day of the new series as well. Friday was very strong. Today is looking reasonably strong as well, and led by a different set of guys. So Mahindra and Mahindra, HUL, Kotak. These are the kind of names from the index which are hitting new highs, which is actually a really good showing. And IT is making a bit of comeback. So banks and IT contributing, you typically don't have the index in the negative, and that's what's happening today as well. So forget just the large cap, look at the small cap names, and all of these, by the way, are stocks also at new highs. First Source, Zensar, what have you. KPIT Technology is up about 4%, trading at new highs too. Avenue Supermarts is about a few points away from hitting the 1 lakh crore market cap mark. Nobody could have thought that this would happen, but arguably the first retail name which will do that. It's come off ever so marginally from the highs of the day. But today is a retail flavor of sorts. Bombay Dyeing, retail stroke real estate. KDDL, which houses that ethos brand of watch boutiques. And Avenue Supermarts. All of these are doing really well for themselves. And while India VIX may be slightly quiet, there is no ebbing of volatility in PC Jewelers. Look at the stock price there. It started off really well, about 5, 6, 7% higher, and then succumbed to some bit of selling pressure, I think off about 12, 13% or 15% from the highs of the day. So this one continues to face the wrong end of the stick.
All right, Neeraj, thanks so much. Markets and within the markets, Reliance in the losers column on the Nifty today. That after earnings mistreat expectations, finance costs and refining margins are the pain points. Somit Sarkar standing by to take us through the numbers and what brokerages are saying on it. Somit.
So if you see the overall numbers for Reliance Industries, they were a bit muted compared to the last quarter. Now, though revenue was up by around 15%, EBITDA declined by close to 2.3%, while margins contracted to 16% in the fourth quarter of financial year 2018 on a standalone basis compared to the last quarter. Now, if you see net profit, however, was higher by 3%, partly aided by higher other income, but some of this was also brought down by higher finance costs. Now, other income was up by around 61%, while finance cost was higher by around 33% compared to the last quarter. Now, the gross refining margin, that is the key number for the core refining business of Reliance Industries, now that came in at around $11 per barrel in the fourth quarter. And if you see, it's premium to the Singapore gross refining margin, that also contracted to $4 per barrel versus $4.4 per barrel reported by the company in the last quarter. Now, because of this weaker GRMs, that is the gross refining margin, and because of lower volumes, the volumes declined by around 6% for the refining business, and because of both these factors, the refining business of the Reliance Industries was overall muted. And if you see the EBIT of refining business, it came down by 9%, and this was a third consecutive fall for the refining EBIT of Reliance Industries. Now, on the other segment that outperformed was the Petchem segment, and from this chart you can clearly see how the Petchem business has been saving Reliance Industries. Now, the Petchem business contribution to the standalone EBIT has increased to 54.3% in the fourth quarter of financial year 2018 from 35% a year ago. So the steady rise in contribution of the Petchem business has been saving Reliance Industries for the last 5 quarters. Now, on the consolidated side, if you see, the retail business has seen some significant improvement. The retail business revenue and EBIT grew around 29% and 95% compared to the last quarter, mainly benefiting from the improved pricing post the festive season in the fourth quarter of financial year 2018.
Hold the thought, Sumit. Let's come back to you about telecom. Reliance Telecom, Jio posted muted set of numbers. average revenue per user declining, but that's not just the story of Jio. Idea reported weak set of numbers on Saturday, although losses narrowed. Airtel posted loss in its India wireless operations for the first time in 15 years. So how do these companies, Airtel, Jio and Idea, stack up against each other for the fourth quarter?
So if you see the average revenue per user, now that declined for all the three operators, but it declined the most for the one who initiated the tariff war. Now Reliance Jio's average revenue per user declined by 11% to 137 rupees per user, while that of Airtel and Idea declined by only 6% and 8% compared to the last quarter. On the operation wise, if you see, Airtel has seen a lot of pressure on its India wireless business. Airtel's EBITDA from the India wireless business declined to 2,943 crore rupees in the fourth quarter of financial year 2018, while that of Idea increased by 18% to 1,447 crore rupees. Jio's EBITDA remained largely stable at close to 2,700 crore rupees in the fourth quarter. Now on the consumption side, there is a data consumption side. If you see, the total data consumption remained the highest on Jio's network. It was around 5,060 million GBs on Jio's network, and it increased by only 17%, while that of on Airtel's network and Idea's network, if you see, it has increased by 39% on Airtel's network, and on Idea's network the total data consumption increased by 43% compared to the last quarter. Now Reliance Jio continued to add the most number of subscribers on its network. The total number of subscribers on Jio's network as of March 2018 was close to 18.66 crore, while that of Airtel was close to 30 crore and that of Idea was close to 19.5 crore. Now this has increased by 17% compared to the last quarter, while that of Airtel and Idea has only increased by close to 4 and 3% compared to the last quarter. Now talking about subscribers, let's see the subscriber attrition rate, which is also known as the churn ratio. Now that has remained lowest for Jio in the fourth quarter. It came at around 0.25% monthly numbers. These are the monthly churn numbers, which came in at 0.25%. Now it declined for all the operators compared to the last quarter, but it remained highest for Idea at around 4.3% monthly churn ratio. Now, Jio, which has been adding the most number of subscribers, has also been spending the most on its capital expenditure. Now, if you see in the fourth quarter of financial year 2018, Jio's capital expenditure was more than double the combined capital expenditure of Airtel and Idea. Now, Jio's capital expenditure was close to 13,000 crore rupees, while the Airtel and Idea combined spent close to 5,400 crore rupees in their capital expenditure in the fourth quarter of financial year 2018. Now, with rising capex, the debt has also been rising for all the three operators. Airtel's debt rose to around 95,000 crore rupees, while Jio's increased to 57,000 crore rupees. Now, Idea saw a decline in its debt because of the fund infusion that they did during the quarter. However, though Airtel's debt is highest in the industry, its leverage ratio, that is the net debt to EBITDA, is the lowest. It stands at around 3.5 times in the fourth quarter of financial year 2018, while that of Reliance Jio is close to 5.3 times and that of Idea is close to 9 times.
All right, Salman, thanks so much for that. India's second largest lender by market cap and the largest mortgage lender will report fourth quarter earnings today, and Shraddha Babla is standing by with the street expectations. Shraddha, what do we expect?
As far as Kotak Bank is concerned, it's expected to be a really strong quarter because Kotak does not face the kind of stress that some of corporate stress as some of the other banks do. So in terms of numbers, net profit is seen growing by about 25% to 1,221 crores. Loan growth seen at 23%, at the same pace that was seen in the third quarter. Asset quality expected to be stable, and hence loan loss provisions will also remain or are expected to remain flattish on a sequential basis. That apart, remember that they don't even need to make too much incremental provisioning as far as the NCLT exposures are concerned. After the third quarter, the management had said that their exposure to the NCLT 2 accounts at least stands at just about 300 to 400 crores, and they already have a 65% provision cover on that. So there's no need for them to the divergence. The RBI audit was also completed in the last quarter itself, and there was no divergence reported. So broadly, it should be a steady, stable quarter for the bank. What will be important to watch out for will be the performance on CASA, fee income, SME retail demand, incremental margin trends and growth, and also most importantly the performance of their non-banking subsidiaries. When it comes to HDFC, again a big 25% sort of a jump in the net profit number is expected at 2,551 crores. So strong solid growth coming in there, but on a sequential basis, to remember, it might seem like a big dip because the third quarter, the December quarter, had exceptional exceptional gains of 3675 crores, which came in on account of sale of stake in HDFC Standard Life Insurance. In fact, in a pre-earnings update, HDFC has also said that they have sold stake in subsidiaries HDFC Developers and HDFC Realty, and hence there are some gains of 265 odd crores from those two subsidiaries, and they will be making about 80 crores of special one-time provision from those gains. So all of that will play out into the net profit growth. In terms of the other parameters, spreads are likely to remain stable around that 2.3% mark. Loan growth seen at about 18% in line with recent trends, and asset quality expected to remain steady around that 1.15% sort of a gross NPA number. What is going to be important to watch? The loan growth trends, especially in affordable housing, and if that corporate loan pickup that we've seen in the third quarter persists, movement in spreads and margins, asset quality of the corporate portfolio, and any management commentary with respect to inorganic acquisition is also what will be keenly watched.
Shraddha, thank you so much for that. The man who's credited with propelling IndiGo to the top of the Indian aviation sector has now decided to step down. Aditya Ghosh resigned from the post of President and whole-time Director of Interglobe Aviation. Co-founder Rahul Bhatia will be the interim CEO, while Gregory Taylor has been appointed Senior Advisor. Taylor is also being considered for the top job. The company statement, that's according to a company statement. What does this mean for Aditya Ghosh's exit, mean for the airline that's grappling with engine failures? Remember, aviation consultant Mark Martin, founder and CEO of Martin Consulting, now joins us to discuss this. Mark, thank you so much for joining us on Bloomberg Quint. What have you made of Aditya Ghosh's exit, coming as it does after he sort of took this company, to profitability, to growth in market share, or rather dominance in market share? What have you made of the circumstances that surrounded his exit? Mark, if you can hear me, I was asking you if what have you made of Aditya Ghosh's exit as the top boss of IndiGo? Okay, we seem to have some trouble connecting to Mark Martin. We'll try and reconnect that line. But here's the basic story. Aditya Ghosh, the CEO of IndiGo, steps down at a time when the market share of the company has been threatened. They've been facing a bunch of crises. One is the issues concerning with the Airbus Neo 320s, the Whitten-Pratt engines that have forced grounding of several of their aircraft, which has come as a blow for the airline. The second is a fairly public outcry over the manhandling of a passenger by IndiGo staff that led to quite a bit of backlash on the brand of IndiGo. You didn't see the CEO come out and you did see the CEO come out against the manhandling immediately. It took a couple of days for that. So that's the IndiGo story for you for now. We'll try and repass that line with Mark Martin to understand what this means, what the exit of the CEO means for the company. But let's talk about All Cargo.
Yes, we will come back to that story. All Cargo Logistics wants to build an Uber for shipping. The biggest Indian cargo company plans to emulate Uber technologies to boost its business of sharing marine containers. Bloomberg News PR Sanjay joins us with the details. Sanjay, what have you picked up?
So, All Cargo Logistics is a port-based logistics company which runs CFS, which is container freight stations, ICDs, inland container depots, stuff business. And of course, it's one of the largest NVOCCs, which would mean they don't really own a vessel, but they own a slot where they can put in containers. They own. So technically, they are claiming themselves that they are the Ubers in traditional times. So, but what they were lacking is the robust technological infrastructure. So now, after seeing Uber picking up a lot of hitting headlines for because of the valuation, they also would want to build up a robust technological infrastructure, which will have an interface where anybody can book a slot or a cargo or shipping assignment sitting from anywhere. And of course, as you know, that they have already bought out their principal at one point of time, which is EQ-Line, EC Worldwide, now known as ECU Worldwide, which has a lot of presence across the world. So they think logically they can create a better Uber facility, and they are trying to learn some good lessons from Uber by creating a technological interface which can increase their revenue and volumes as well.
All right, and this is being done in-house.
Oh, this is of course done by in-house, and they have huge technological support and network support from ECU Worldwide, which is known for its freight forwarding operations, known for NVOCC operations, which they are expecting. Shashikaran Shetty, Chairman and Managing Director, is expecting that a huge increase in volume. Though they are not giving us a clear-cut figure for that, but they are expecting a huge volume increase push.
Sanjay, thank you for that. Let's bring up that stock of all cargo. It's trying to do something with its technology, but that stock is down nearly 2% in trade today. Let's get back to the story about IndiGo. Mark Martin, founder and CEO of Martin Consulting, joins us from studios in Delhi. Mark, thank you so much for joining in. What have you made of the circumstances around which, when Aditya Ghosh has stepped down as the CEO, what led to this exit, do you think?
Look, first up, thanks for having me on the show today. Look, IndiGo is in a phase of global expansion, and as airlines expand, when they look at new territories and regions, it makes strategic sense for you to have a sort of a global workforce to help leverage the brand globally. Now, IndiGo has had a pretty rough past with Singapore and Southeast Asian operations not doing very well. So obviously, it makes sense to bring in people with the right skill set. So it's a step in the right direction.
But do you not think that it sort of came a little bit too suddenly? At least in public circles, there was no discussion of a change in management. Also, there was no obvious sort of second rung bench strength which would take over when Aditya Ghosh left. So in that sense, a little bit of a jarring move, at least for investors.
Hi, yeah, for sure, because I think the reason why everybody seems to be pretty edgy is because it comes all of a sudden. It is something which was not planned. We never saw a heads up. But I think the July 31st phase out, or the official exit date, should give us an indication of how this is going to be tapered. And also, I think the abruptness of this over the weekend has created a tremendous amount of turmoil with markets and everybody around. I mean, let's face it, at some point that news had to get out, and whether it's through a press conference or a press release, the sooner they do it, the better.
Mark, do you think Aditya Ghosh is paying the price for choosing the Pratt & Whitney engines, which seem to have... Did that cost his job?
Look, I mean, let's face it, Aditya's done an outstanding job with IndiGo. A guy who's got absolutely no aviation expertise, a trained lawyer by background, comes in, looks at aircraft leasing contracts, transitions an airline from 4 to 160 aircraft in 10 years. One of the largest airlines by market capital. So his contribution is immense. But also you must understand that, Aditya is a good manager. To run an airline, you need flight operations people, you need engineering people, maintenance, network, distribution, and sales. So, yes, you do need managers, but at some point in time, you need to start getting specialists, because now IndiGo shifts its gears. It's no longer that a fun local regional airline. They're going global, and when an airline goes global, you need to get people with global skill sets. And I think global skill sets is key. We've seen it with Emirates Airline, with Etihad, with Qatar, Oman, Singapore Airlines. So the long and short of it is that we got to respect his contribution. We should appreciate what he's done. But now the entire mode has changed at IndiGo. Now we're looking at a whole different battleground.
You're actually seeing this as, at least not a negative event risk for the company. Do you suspect that the airline also is now at a sort of, for the want of a better word, at a steady state? So if there is one management change at the top, it should probably not change direction dramatically for the company or the airline.
Oh no, if you really look at it and look at the details, I mean, the brains behind IndiGo was, Bhatia and Gangwal. Gangwal came from US Airways. He came with an airline operating background. He knew the aircraft leasing business, being an aircraft finance guy. And of course, Bhatia was very well aware of the travel trade even before we knew it. So I think Aditya kind of, in many ways, supplemented and augmented that team quite well. But to kind of say that the entire weight of IndiGo's shoulders rested on Aditya Ghosh is not really true. He was there for a certain purpose. He's done his job. He's done an outstandingly amazing job at running that airline. And I think we need to look at this in a positive manner because, as good managers, they have to move on and find better challenges and something more effective to do with their professional life.
Mark, we'll leave it there. Thank you so much indeed for joining us. Mark Martin talking about Aditya Ghosh's exit and what this means for the airline. Up next, Fitch has affirmed India's rating at BBB negative. We'll talk to Fitch's sovereign ratings director, Thomas Ruckmacher, on the other side.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार, just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे,
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth platform from India's largest stock exchange.
What if lucky discoveries could be discovered without luck? What if the secret code to investing was no longer secret? Could the complexities of business not be so complex anymore? Decode, demystify, learn. BQ Learning. Only on Bloomberg Quint.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. Indian equities begin the truncated week on a strong note. Banking and IT stocks lead.
The Reserve Bank of India relaxes rules for foreign investments in government and corporate bonds, also widens the pool of companies eligible for tapping the ECB route.
PFRDA chairman is hopeful that the Finance Ministry will soon allow government employees to invest up to 50% of their pension fund corpus in equities. That's a Bloomberg News exclusive.
From the earnings corner, expect a strong show by index heavyweight HDFC. Kotak Mahindra Bank is also expected to maintain its growth momentum.
All right, let's first take a look at the markets once again. About a 0.5% bit more than that gain on the Sensex and the Nifty. Agam is here with the gainers. Agam.
Good afternoon, Hira. Well, with the 0.5% gain on the Nifty 50 index today, it's also moved above the relative strength index. That is a 14-day RSI of 70, which does indicate that Nifty to a certain extent is in overbought territory, at least as per that parameter. That said, we're looking at strength in the information technology sector, and we're also looking at gains coming in the public sector banks, at least some of them. Of course, on the whole, we're in terms of of the broader markets too, which are moving in tandem with the benchmark indices, something like a mid-cap or the small-cap index, both are advancing to a certain extent, outperforming the benchmark indices. In terms of big gainers in today's day of trade, we are looking at TCS, aiding the Nifty IT index advancing. Along with that, we've also had gains coming in, something like a Yes Bank that's also up 4.5%, and HUL along with Vedanta are among the other reasons why the benchmark indices are currently buoyant. On the losing end, however, profit taking seen in Axis Bank after the 9% up move we saw on last Friday, and UPL along with Reliance Industries declining largely on account of earnings that we saw last week. But on the whole, the indices looking strong for now, and as I mentioned, trading above some of the overbought zones when it comes to some of the technical parameters.
All right, thanks so much for that, Agam. That's the equity market check. Now, the money markets are closed today, both the currency and the bond markets today and tomorrow. So it's only on Wednesday that we'll see a reaction to the Reserve Bank of India's move to actually widen the scope of foreign portfolio investment in Indian debt. But it's an important move, one that has implications potentially, of course, for yields in the short term, but in the medium term has implications for increased volatility in the bond markets. Let me just run you through what the RBI has done. Well, for starters, on the government bond side, they have removed the stipulation that you can only invest in government bonds with a residual maturity of 3 years. Now you can invest in all government securities. Earlier, this 3-year stipulation had been introduced after the 2013 taper tantrum when you saw flight of money from short-term government bonds, in particular T-bills. Now, it's not clear whether T-bills have been opened up for foreign investors or not, but even without that, you could potentially see more money come into the shorter end of the curve and maybe some decline in yields at that curve. On the corporate bond side, what the Reserve Bank of India has done is once again remove the 3-year residual maturity stipulation and bring it down to 1 year. This should again widen the pool of securities in which foreign investors can invest. Until now, they could only invest in securities which had a residual maturity of 3 years. The short end of the corporate bond curve should see some relief on this. But it's not clear as to how much and how quick, because remember, we do have a continued supply-demand mismatch in the bond markets. There are a few other changes that have been brought in, and this is on the concentration limits. There has been an increase in the cap on how much a single FPI can hold in a single listed security to 30% from 20% in the case of government bonds. In the case of corporate bonds, though, there is a cap of 50% that has been introduced. So some people saying that could have an impact on private placements of corporate bond issues if an FPI was being given more than 50%. So broadly speaking, this is what the Reserve Bank of India has done. The only concern is that if this has been done because of the weakening rupee, and remember the rupee has weakened partly due to FI outflows on the debt side, then the RBI is sort of playing with fire a little bit, because we have seen a fair amount of instability emerge from sales in the debt market in the 2013-14 period. In March and April, as you can see on your screen, there have been some fairly heavy selling in the debt markets. So one hopes, Harsha, that the RBI has not done this in a reactive fashion and they have some bigger game plan behind this move.
Let's wait and watch on how the markets really react to this, as Ira was mentioning, only on Wednesday. But here's another one. Fitch has affirmed India's long-term rating at BBB negative with a stable outlook. The rating agency says it has balanced a strong medium-term growth outlook and favorable external balances with weak fiscal finances and some lagging structural reforms. Ira caught up with Thomas Rukmarker, Director of Sovereign Ratings at Fitch, to discuss these factors in greater detail. She started by asking him if the government's finances and debt levels continue to be the biggest constraints on India's rating. Listen.
We believe that the government's finances are the Achilles heel in the sovereign credit profile of India. If you look at the general government debt levels, they're currently very high. 69% of GDP is the general government debt at this moment. And we do expect debt to come down in the coming years. But not immediately. Next year, we also expect the debt level to be close to 69% of GDP. And if you compare that to other countries, the BBB category median, so that's the median of all the countries rated BBB minus, like India, BBB flat, or BBB plus is 41% of GDP. So there's still quite a large gap.
Okay. Thomas, on the fiscal deficit side, though, I think, last year the slippage was explained away by saying that it was a year of structural change, particularly the implementation of the new indirect tax system. How much sort of, leeway does Fitch give India on the slippage on last year's fiscal deficit? Because I note that you talk about the fact that you're also worried that the 3% target, which had been set a while back, will not be met for some time now.
Yes, well, that has to do clearly also with how confident you can be about the general government debt level coming down. Now, with the FRBM Act in place, and the aim to reach the 3% of GDP deficit for the central government, that aim or that target has been kicked out again. If you look at the adoption of the FRBM committee recommendations and the focus on bringing down debt in the longer run, so the debt ceiling of 60% for the general government and 40% for the central government, that's actually a very positive development, but a lot of it also depends on implementation. So the question becomes, okay, how confident are we that this debt level is going to come down substantially to this level of the ceiling?
So essentially, you're saying you'd want to see debt levels start to come down before, at least that weight on the rating goes away?
Well, it has to do with confidence that this debt level is coming down, it's all about implementation in the end. The track record of the governments since 2008 of implementing the FRBM Act is not great, as we all know. And you can't cross the sea merely by standing and staring at the water, as Rabindranath Tagore once said. You have to do things as well. It's about implementation.
All right, that's a nice way to put it, Thomas. Let me just ask you for your view on, the GST and whether you see that as something that could materially change the government's finances by pushing up the tax to GDP ratio. Again, are you convinced it'll happen, or do you still want to see proof of the tax base widening before you give some credit to that reform?
Well, first of all, credit to that reform. It's an important reform, especially when it comes to the trade part of it. So the transaction costs involved, which are now less. In terms of the revenue intake, you can be quite optimistic in the sense that, well, there's more compliance to be expected as a result of the GST implementation. Although in our own forecasts, we haven't increased the revenue intake substantially, just only gradually. But it's an upside risk. That's the way we approach it. An upside risk to the revenues.
Okay. A more near-term downside risk to government finances, but also more importantly to the current account, could emerge from the way oil prices have moved, Thomas. I know that you take a more medium-term view, but there's no denying that 4 years of calm that the Indian economy had on account of moderate oil prices could be challenged now.
Yes. Of course, there's the fiscal question. So, then the question becomes, okay, what's this government going to do? To give them credit, in the past couple of years, they've liberalized the administrative fuel prices quite a bit. So in that sense, they won't be hit as hard as others, but it also depends on the policies going forward. What are they going to do with the excise tax, for instance? Looking at the oil prices, I think it's especially interesting to see how the current account is going to look like in the years ahead. So we have a widening of the current account already without a presumption of oil prices to stay where they are right now. And the current account is now, FDI has fallen as well, net FDI, and is now no longer sufficient to cover the current account deficit. So the basic balance, which is the current account balance plus the net FDI inflows, is turning to a deficit, and makes the external finances of India a little bit weaker. India's external finances are still strong compared with peers. The reserve buffers are strong. So reserve buffers currently of 8.3 months of current account payments. So that relates to 7.0 months for the peer median. So still strong, but the oil prices are going or could have an impact on the external front as well.
Right. On the domestic economy, Thomas, what is your view on both growth and inflation? I note that you're only expecting interest rate increases next year in the Indian economy.
Yes, that's correct. We expect growth to pick up to 7.3% this fiscal and 7.5% next fiscal. The early indications are already that this is happening. Inflation is a bit of an uncertain factor, so we expect inflation to be 4.9% at the end of this fiscal year, and it's a bit uncertain, not just because of the oil prices, which could have an impact, but also because of government measures like the minimum support price hike. It's uncertain what the impact is going to be on inflation, but it's an upside, mainly an upside risk, I would say. And in terms of monetary policy, we don't expect in our baseline a hike this calendar year, but we expect the RBI to start next year to hike. Having said that, with the upside risks there of higher oil prices and also an impact of the minimum support price hike, you could imagine the RBI to move earlier, especially since it's so important to them, to this still rather new Monetary Policy Committee, to build a strong track record, and that's exactly what they're doing now. So since their establishment and their first meeting, we haven't seen inflation cross the range, the official target range. So inflation has been within the range.
Absolutely.
And we expect
Sorry, Thomas, we lost your audio there for a minute, but I was just going to switch focus to what you think the impact of the banking sector problems is going to be on the economy and on growth in the economy. I know that you have put in a note saying that you don't think that the capital that has been put in will be adequate to restart lending because most of it will get used in the cleanup.
Yes, exactly. So that's going to be a very gradual process. The impact of the cleanup on growth. I mean, this cleanup starts, of course, with recognizing that bad debts are a problem. The government has done that, and RBI quite some time ago, and are now implementing the reforms and providing capital. But before you get the economy going, that might or get the impact on the economy that may take some time.
That's a view from Fitch. Let's move on now. Over the weekend, the government announced that it had achieved the target of electrifying all villages across the country. While the Modi government has managed to electrify more than 18,000 villages, millions of Indians still live in the dark. Bloomberg News' Rajesh Kumar Singh dissects the government's data to shed more light on the government's claims. Rajesh, the claims aside, how stark is the difference between what is being claimed and what's the reality on the ground?
Well, there are two parts of the rural electrification program, and basically the first step is the village electrification program, and the second step is taking the electricity to the last mile, which is the households. So the village electrification, the government claims, is done. As you said, more than 18,000 villages have been electrified. The much larger and the much more challenging step is the household electrification, wherein we are seeing, according to the government data, still 32 million homes, about 32 million homes are unelectrified. So that is going to be a really tough challenge because of, for the sheer reason that it involves in dealing with individuals. These number of 32 million homes are spread across about 25 states, and it would need the government machinery to work really closely with the people on the ground to meet that deadline of end of March 2019.
All right, thank you so much for that, Rajesh. That's the electrification story and what's happening there. As the summer heat grips the country, getting water becomes especially difficult in rural India. Statistics suggest that women in villages have had to devote 30 minutes every day to fetch water from their homes. To solve this crisis, here's how a professor from the University of Glasgow has come up with a unique solution.
உங்கள் வீட்டுக்கு செல்ல வழி காட்டுவீர்களா? நாம் தண்ணீரை அங்கு எடுத்து செல்லலாம்.
All right, India's $2.3 trillion equity market may get a new endorsement. The country's pension regulator is hopeful that the finance ministry will soon allow government employees to invest up to 50% of their pension fund corpus in equities. Vrishti Beniwal of Bloomberg News now joins us with more details. What is the pension fund regulator's view on this, and does this mean half of pension funds will actually go into stocks immediately, Vrishti?
Harsha, the pension regulator, the chairman of PFRDA, Mr. Hemant Contractor, we met him and he told us they have been asking the government for a very long time to increase the portion of equity the portion the government employees can put in equity. So he is saying the government is very positive on this, and we may soon hear it from the government. They might allow their employees to put more money in equities. Right now it's capped at 15%. PFRDA wants it at 50%, but we have to see whether the government allows it at 50% or little less than that. But if they take it to 50%, that will match the contribution that private sector employees can make to NPS. And there is another proposal before PFRDA, that is to increase the portion private sector can invest in NPS. They want to increase it to 75%. PFRDA is looking at that. They have not taken a final call because there are many risks which are associated with increasing the limit in equities. So PFRDA will look at this proposal, and they don't need any government approval as far as private sector is concerned. So these are the two things which might happen anytime soon in the future.
Vrishti, thank you so much for that. Vrishti Beniwal reporting from our studios in Delhi.
That's a wrap here on Power Lunch. Thanks so much for watching.
Up next is Countdown.